Hey everybody, welcome to another episode of Stock Talk. My name is Amin Reina. I'm an investment coach here at Sage Investors, and this is episode 48. And today I want to talk a little bit about ETFs, specifically the kind of race to the bottom that seems to be going on with various ETF companies in terms of lowering their costs. There's just been, especially in the United States, there's just been a pretty crazy price war between a lot of the big name ETF companies in terms of lowering their MER costs. For example, BlackRock just recently announced that some of their funds, they've lowered their MER, the management expense ratio, on some of their ETFs down to 0.04% or 4 basis points. And it was just after they announced that, Charles Schwab, another big player in the ETF market, they matched. And so it's just it's almost like a big race to the bottom in terms of lowering ETF costs, which is again making a good business case if you're interested in investing in ETFs, why ETFs are a bit of a good value proposition in terms of costs. They're cheap, they're practically cost nothing. And it's happening. The question is, when are you going to get into the world where we're going to have zero free ETFs? Zero cost ETFs, and it's already happening because I believe there's one small firm, a boutique firm called Cambria Global Asset Management. Some of their European ETFs, they're charging like 0%, so there's no costs. So wow, it's kind of crazy. And there's actually now starting to hear some talk now about charging negative costs. Believe it, we hear so much about negative interest rates. Well, we're now starting to hear about negative MERs, which is basically tantamount to a rebate. Basically, you're getting paid as an investor. I would get paid to hold a specific ETF, and so I get a little bit of a discount. In a way, I'm kind of getting a discount to do that. So that's great for you and I. That's awesome in terms of lowering a cost. That's one of the core things we want to try and do with our investment when we make investment decisions is to minimize our costs as much as we can so we keep more money in our pocket. The question I always keep asking myself is, okay, if costs are coming down ridiculously to a ridiculous level, what's the point for these companies? What's the value proposition? How do these companies make money? If you're charging people nothing to own your fund, or you're paying people now, if you're thinking of actually paying people to model, how do you make money? And I've really scratched my head on this kind of thing and trying to figure this out. And actually, got a little bit of an answer. I was reading an article in the Wall Street Journal like a couple of weeks ago, and they kind of opened the door a little bit, kind of like Oz, in terms of how these ETFs can thrive and sustain themselves in this hyper-competitive, low-cost market. And the answer really is it's lending. What these ETFs companies do quite a bit is they lend their securities to other companies, other other financial institutions, brokerage companies, hedge funds. Why would they want to do that? Well, because, for example, a hedge fund or a brokerage company might want to, some of their customers want to short the market or short specific indexes, and so they'll need to borrow stock to go short, and then ultimately hoping that the ETF or the index will go down lower, and they'll make money off it. So they'll come to ETF. So the brokerage companies and the hedge funds will come to the ETF company and say, "Hey, can you issue some more ETFs so we can lend it out? We'll pay you back." And they make money doing that. And in fact, they make obviously more money doing that than they do just selling it to you and I, because clearly they're charging us nothing. So usually the way the money works is that the cost of doing that, or the collateral, the company needs to have about 102% of capital. That seems to be the going rate. And then the ETF company will charge a fee on top of it. Net result, at the end of the day, after all the mechanics of it are done, the ROI for the ETF company on this type of transaction will range on average between 3 basis points, 0.03%, and 0.1%, which doesn't sound like a hell of a lot of a return, but we're not talking about, lending out 100 shares here. They're lending out hundreds of millions and billions of dollars out here. So the numbers, the return can add up pretty nicely. And actually, in the article, they actually cited a couple of examples, a couple of ETFs out there. The one was the iShares Russell 2000 Index, which is a pretty broad-based ETF. They generated $72 million in lending fees last year. And that's on top of the $53 million in management fees that they collected. So that's just one ETF. And so if you can imagine having a wide variety of ETFs, and you'll be able to generate that kind of return pretty seamlessly, lending your shares out and being kind of a lender out there, that's not a bad business to be in. So it kind of was like, oh, okay, now it kind of seems to come together a little bit. So what's their incentive? The big incentive for ETFs is they're willing to absorb the cost of getting you and I to buy it, to bump up the assets, to increase the liquidity of that ETF, to make it more attractive. And if it's more attractive, if it's trading more effectively, then you're going to attract more business from the institutional side, who's going to use it to borrow, go short, and to do whatever financial engineerings or complete or fill in the blanks in some kind of whatever financial transactions they're undertaking. So it's a circle of life, isn't it? So I thought I wanted to share that with you because it's just something you're not going to hear about. And I found it really interesting that that kind of curtain was open slightly. And I'm sure there's other reasons out there, and I'm sure if I find them, I'm more than happy to share them with you. But I thought I'd share it with you like that. So that's pretty much all I have for you today. If you have any questions about this or any other previous episodes of Stock Talk that I've done, feel free to contact me through Twitter. My handle is @SageInvestors. I'm on there tweeting all the time, my personal investment decisions, my personal observations on the markets. Or you can hit me through my website, www.sageinvestors.ca. Hit me through an email. I'm more than happy to chat and respond to you there. So that's all I got for you today. It's another episode of Stock Talk. My name is Amin Reina of Sage Investors, and we'll catch you again another time. Cheers.